Welcome to our KFG 2020 investment review and 2021 outlook. My name is Mike Bernard. I am one of the certified financial planners right here at Korhorn Financial Group. I'm also the host of the Wise Money Show and our radio show and all of our content there on YouTube. So make sure you check that out as well. It was the best of times and it was the worst of times in 2020. I mean, one of the most unusual years in the stock market, maybe ever, certainly in my 20-year career. And we're going to be reviewing what happened last year, talk about how our KFG models and our actual KFG investments did and how they responded and how they all worked in 2020. And then also look ahead to 2021. How should you be positioned? What's likely to impact the market? So that's coming up this half hour, 40 minutes or so. Thanks for spending some time with me. If we jump into what actually happened last year, it didn't take long for things to go from pretty normal to absolute panic, sheer panic, actually. So we got off the year pretty strong. I remember actually being at a restaurant in second or third week in January thinking, gosh, I wonder if this coronavirus, I wonder even what that is. I wonder if it will come to the United States. But the markets were still normal. And I was thinking, well, will this impact the markets because of supply chain issues with China and all that sort of stuff? And it didn't. And then all of a sudden it did. And you can see that waterfall drop there going really from the last week in February to really the end of March. That was the biggest drop from an all-time high ever. Unfortunately, lots of negative records were broken here. It's the fastest bear market decline ever. A bear market is a drop of 20% or more. And you can see here it took just 20 days to fall into a bear market. That's the fastest bear market decline ever. The worst quarterly GDP ever. Of course, that data doesn't come out until after, but when they shut down the economy, that broke a record on the negative side. And of course, record job losses as well. Fastest job losses on record as well. Now, if we go back and what's the rest of the story? Everything started, I mean, as bad as things got, they just changed. It just changed in the market. And I remember thinking, yeah, I don't know if that was the bottom. History tells us that wasn't the bottom, but it was. It was. Everything just surged off of the bottom. Things rebounded very, very quickly. And you can see that's just about as close of a straight line as the stock market can draw from those bottoms at the end of March right through the end of the year. Despite all the election turmoil, despite the COVID shutdowns and things being reopened and then second wave, it's pretty unbelievable. So with those negatives, the positives started roaring in as well. It's the best 50 days in the stock market ever. Best 100 days in the stock market since the Great Depression. And I'm not just talking about the stock market. Let's pan out a little bit. In blue there, that's the S&P 500, so that's large cap U.S. stocks. But look at red, look at orange, look at purple. Those are colors I just made up. That's small cap, that's international, that's emerging markets. Really, a rising tide lifted all boats, not in the same magnitude. Okay, look at small cap, how quickly small cap drops. Small company stocks were not as well positioned as large company stocks to kind of shoulder what COVID and those shutdowns threw at them. So, of course, they dropped more. They took a longer time to rebound, but as we'll talk about in just a second, they surged at the end. Even emerging markets, international, everything recovered really in tandem, not in the same magnitude, but in tandem as the U.S. stock market did. So those positives kept rolling. The best month ever in small capital stocks. That might seem like a small deal. No, the previous best month ever was up 15%. And the small caps actually hit that several times in a month, okay? In a month. No, they were up 20% in November, 20%. We have the most accommodative financial conditions on record. Yes, nerds like me actually track that sort of stuff. The most accommodative financial conditions ever, easy money and lots of ammunition thrown at it by Congress and by the Fed to keep the economy boosting. And part of that is we've got the lowest mortgage rates ever as well. Kept hitting that record, breaking that record, hitting a new record. But it hasn't been all good. So we went from everything okay to bad, and then we got some good. But all this good, unfortunately, guys, is creating some negatives. we now have the second highest price to earnings valuations ever on record. And price to earnings, that's the price of a company or the price of the stock market compared to the earnings, the profits of that company. So how much are you needing to pay, price, for $1's worth of earnings? Okay, we're going to get into that a little bit more here in just a second, but we now have the second highest ever on record. The highest ever market cap to GDP ratio ever. Warren Buffett says that's the single greatest measure of whether the stock market's expensive or cheap. And now it's at the highest level ever. And we have a record high margin debt, which if I can say simply is we have a record amount of people borrowing money to buy stocks. A record amount of speculation taking place in the stock market right now. With that recap, now really what was driving the markets? What drove all of that ups and downs, all the red, all the green? What drove that, okay? And I think it's pretty obvious. I would say it was the most intervention we've ever had from Congress. The most intervention we've ever had in the economy from Congress. Why? Because we had to shut the economy down. That was congressional action. Now, whether you agree with it or not, and obviously we're still dealing with municipalities that have, partial shutdown and so on. I'm not saying one way was right, one way is wrong. It just, that intervention created a huge impact in the economy and the stock market. And then on the flip side, we've seen unprecedented levels of Federal Reserve and congressional stimulus. That also is intervention, right? Manipulation or whatever, just printing money, injecting it into the economy. If we can just nerd out on you for just a second, this is the money supply. So this is how much money is actually sloshing around out there in the economy. And I have the chart going back from before the Great Recession, before '08. And you can see we printed $1 trillion there. That was a little bit of increase, but then we had to keep printing money. We never were able to take the economy off life support. And then look at what happened in 2020 in response to the coronavirus. The money printer just got turned on and it hasn't stopped. You want to know some crazy details? 23% of all dollars in existence were created last year. It's unbelievable. Unbelievable. One other thing that we're watching closely here, the more money printing, the more stimulus, the more that is happening, the less frequently the same dollars being spent throughout the economy. That's velocity of money. And this is something we're watching very much. The more money they're printing, the more stimulus, it looks as though that money's landing into the financial economy, but it's not actually being spent that quickly. So it's landing into assets, but how frequently do you sell your house? How frequently do you sell stocks and buy something, right? So the money that's being printed is helping to lift the economy, but it's not actually going down to money that is actually being spent. This is an alarming chart to us, and it's something we're watching here at KFG for future interpretation and future influence. Now, speaking of influence, one of the other themes is back in March, the Fed dropped interest rates to the lowest rate ever, 0%. And I remember that was an emergency session announcement that they made on a Sunday. The Fed was going to meet later that week. And they came out on Sunday and spooked the market, panicked everyone, and said, we're dropping rates to 0. And so if you look at this chart here of interest rates, this is astounding. The gray bars here show the amount of interest that you could earn in a savings account, say with $100,000 in it, based on the interest rates at the time, okay? That's how much you could earn any given year. And then those blue hash marks, that's what, quote unquote, inflation was during that year. Look at that. You could draw a line right up to 2000. You were earning enough interest to at least cover inflation, maybe and then some. Then we had the recession, but then that resumed. 05, 06, 07, you were making enough in interest in the bank to at least cover inflation. And then you could draw a line and it is completely different. The dollars that you have sitting in the savings account, and I'm not showing you this chart to say, you need to get your money out of there. No way. That money in there is not to make you rich. It's to keep you from being poor. So that has a purpose there. However, it's just outrageous to see how little interest you're getting, and it's not even keeping up with inflation, a far cry from it, okay? Will we ever see interest rates that are meeting or beating inflation again? I don't know. I don't know based on current monetary policy. And so, but what this does illustrate, even though we wouldn't tell you when we look at your overall financial plan, get out of cash completely and put everything into the markets, interest rates, keeping interest rates this low, it's basically baiting people to say, well, there's no place else to earn money. You can't keep it in savings because you're safely losing your purchasing power every day because inflation is more than what you're receiving in interest. The other big trends and themes for 2020, the momentum of tech and growth stock. It seemed like the year of Tesla and Apple and Spotify and Shopify and Zoom. I mean, some of these companies just absolutely took off. Tech and growth very much in favor. We're going to talk about that when we talk about our momentum strategy. The presidential election was an enormous theme. It's fifth or sixth on my list here. That's unbelievable. It obviously was a headline all throughout the year, and we've got all sorts of issues, guys. You know that. Did it really drive the markets? I can't really say that it did or did as much because it was really not the person sitting in the Oval Office, but the person sitting at the helm of the Federal Reserve that influenced the markets even more. Now, even with the election and the uncertainty afterwards, the market did just fine. So it was a theme, just didn't drive the markets as much. Another theme, small caps lagging all along, and there were lots of people saying, I got to get out of these. They're not doing anything for me. And then they soared at a record pace to end the year. Even emerging markets outperformed the S&P 500 when you look at the full year, even though it was well underperforming midway through the year and after the big drop. And then, of course, as I ended with, we've got alarming levels of valuation and speculation. What we saw with the amount of intervention, let's just continue to use that word, by the Fed, it's now just lured people into taking lots of risk and taking on speculation in the markets. Let's take a look at that PE ratio here. I told you about that earlier, and that's the price that is the price of a stock or the price of the S&P 500 compared to the earnings. It's a geeky chart, bear with me here, but in the middle, in between that top dotted line and the bottom dotted line, you would say that's average. That's an average price to earnings ratio going back to 1995. So the stock market's fairly valued if you're in there, okay? But you can see back in 97, 98, 99, 2000, the PE value, that number was well above that top dotted line. So you'd say the market was expensive. And yeah, we look back on that and we call that the tech bubble. We don't call that the tech era. No, we call it the tech bubble. The stock market was overvalued. It seemed to make sense at the time, but it was a bubble. It was overvalued. Then the drop in 08 and 09 and 10, you could say, yeah, it was below that bottom PE level, that bottom dashed line there. Yeah, the stock market was cheap at that time. No one wanted to own stocks. Where are we today? Where are we today? And look at, guys, the drop in March. We never even got cheap. And now we're at second highest valuation levels. That's alarming. That's alarming. And then if you take a look, and if I geek out on you further, this that market cap to GDP ratio. This is the Warren Buffett indicator. He's gone on record of saying this is the most important measure of the valuation of the market. Is it expensive or is it cheap? And guys, the value of all corporate equities compared to the GDP, the actual output of our economy, is at a record high. A record high. We've surpassed the 1999, the tech bubble. So this is alarming to us, but it's good and bad. If you look at the themes, right? Good and bad. It was the best of times. It was the worst of times in 2020. So that's a recap of 2020 and what really drove that performance. Now, I can't see the future, and you can't either, but what's likely going to be driving this upcoming year, 2021? What are the big investment themes? Well, let's get into it, okay? Obviously, if the economy can remain open, that's significantly important. I have no idea about this other variant. I have no idea if all these vaccines are going to turn us into zombies. I don't know. Just like a year ago, you didn't know, we didn't know that we were going to have a shutdown. So the economy's got to remain open, right? And it looks like we're on that trajectory. Just never know. If it does, we've got this pent-up demand. I know I want to go to Olive Garden. You want to go out to eat. You want to go on vacation. There's money you want to spend. There's things you want to do if the economy can remain open and if it's safe to do so. So if it can and if vaccines can be distributed, pent-up demand, we might actually see that, and we might actually see the economy really boom here. If we do, and we see continued economic congressional stimulus, wow. I mean, the markets really could go crazy. We really could grow into these valuations. We already are seeing another stimulus proposal from Joe Biden, the Biden administration, and it seems likely they're already talking about, well, once that proposal gets passed, there's going to be another one. I can't believe it. But lots of congressional stimulus. But then the other one, to me, the most important theme, I think, aside from whether the economy can stay open, is what's the Fed going to do? So this is the money printing that they're doing is quantitative easing, QE, if you remember those terms from a few years ago. They're injecting $120 billion a month into the economy. Now, that's nearly double what they were doing per month during the Great Recession. When will they stop? And how will they stop? Will it be a gradual stop? Will it be a surprise announcement? Will it be well after they should have? This is the tapering policy. That's what they called it last time. And coming out of the Great Recession, when they tried to start slowing that down, the stock markets had what they called a taper tantrum. The stock market did not like it. We went through 2014, 2015, 2016, where the market was absolutely flat. And anything but. It went up, went down, went up, went down, but didn't make any progress. And that's all in response to how the Fed was changing the way that they were injecting money and supporting the economy. So we'll see. We'll see. That will definitely drive the markets. And then that's connected to whether we'll actually see inflation. All sorts of questions about that. You can't print all this money without seeing inflation. And yet technology resists inflation. Technology makes things cheaper. And so, except your iPhone, I guess. Interest rates are connected to inflation. Will inflation run and then interest rates rise like the Fed has talked about? They said they're going to keep interest rates at zero for a couple of years. They might have to increase interest rates if we see inflation go crazy. And then again, stock market valuations. Does the stock market have room to grow? Can it continue to grow in 2021? It's already at high valuations. Well, if the economy actually just goes gangbusters, it could grow into those valuations and we could push valuations even higher. So we'll just have to see, but that definitely will be a theme for this year. And if all of a sudden the market gets spooked and said, wait a second, why are we paying these insane multiples? That could certainly impact the markets. Now, before we go into, well, then what should you be doing? Let's reflect on how our KFG models, our investments, your investments performed last year. As we do that, I want to first remind you of our overall investment philosophy because it is uniquely different. And I would argue it's uniquely better. We all know the investment mantra that don't have all your eggs in one basket. Well, the only reason we say that is because we don't want all of our eggs to break at the same time. Okay, but during extreme market events, when everything's going down, all of those baskets tend to be going down at once, except for cash. And so diversification of just stocks and bonds, large, mid, small, U.S. international, that fails when you need it the most. So how do we solve that here at KFG? We diversify your investment strategies. Not just diversifying your holdings. You got to diversify your strategies if you really want to make sure truly that your eggs are in different baskets, right? So how we apply that here is we've got a buy and hold approach and a momentum approach. We call one strategic and core, that's buy and hold, and we call the momentum fund, the momentum strategy, we call that dynamic. Now, our philosophy here at KFG that we're implementing for you is not for you to pick one or the other. Our philosophy is that you have both because both gives you that actual diversification. You've got the buy and hold, but you can also adapt using momentum to the changing market environments. How do we do that? Let's break it. Let's go into that strategic and core, that buy and hold approach. Your overall financial plan drives your risk level. And that risk level is how much should be in stocks, how much should be in bonds. Your plan drives that, okay? What are you saving up for? What are you investing for? When do you need the money? And, what are those goals? What are the short-term goals, long-term goals? Your plan drives how much risk you should be taking. But then once we know that, our investment selection process and our review process allows and ensures that we always have the best of breed investment choices available and in your models, in our models here. We've got a 12-point inspection where we look at the entire investing universe and based on 12 different criteria are looking for funds that are only in the top quartile in each of those areas, okay? And when we do that, we take all, 30,000 investment choices. We run our 12-point inspection, our 12-point screens on it, and it narrows down to just a handful of funds that are actually good enough for us to hold. And then we review that. I look at it every day. But ongoing, every month, we rerun that scoring process to say, are these funds that we're holding still the best of breed? And if they're not, we make adjustments, okay? But say that risk level got you to a mix of X amount in large cap stocks, small cap stocks, emerging markets, bonds, international bonds, okay? And we're doing our job to ensure that those pieces of the pie are best of breed investment choices, and they stay that way. Then as the stock market moves way up, way down, and then back way up, you can see that pie chart didn't adjust. It didn't adjust. We're not trying to make big moves and get more into this area or get completely out of stocks. That's not the purpose of our strategic and dynamic, our strategic and core models. That's buy and hold. We're trying to pick great mutual funds, great index funds, great investments, and ride through the ups and downs, all consistent with your financial plan. But that's not it. That's just the buy and hold side. You've got to complement that with a momentum strategy, what we call dynamic. Here's how that works. Your financial plan, again, determines your risk level, but in dynamic, that risk level is derived by, all right, what's the maximum amount you want to have in stocks at any given time? Some people, for their dynamic side, I can go up to 100% if the model's working, or if the model tells me to. If momentum says yes, let's go. Or I want to cap it at 60% or 80%, or I only want to cap it at 20%. Your financial plan determines that. And then our dynamic models, we use a daily momentum scoring system that looks at all investment choices, once again, all of them, once again, to say, all right, where is the momentum? Where is the momentum? We look at that every day. Doesn't mean we make changes every day, but we look at it every day. And then based on that, what has momentum, what's losing momentum, what's gaining momentum, we can actively make adjustments to your holdings within the model. So here's how that works. If you look at this pie chart, again, maybe at one time, our dynamic strategy, the momentum model, has you spread out in growth and tech and small cap, those areas. Well, as the market starts moving, your dynamic model is going to be adapting to those changing trends. As the market started turning over, you saw it adapted to cash. And then as the market starts rebounding, it's going to adapt again based on the momentum and what's doing well. The dynamic investing, dynamic and momentum investing, that's lots of people have questions on that. So let me just hit the highlights before we go into how it did. It's not market timing. No one knows what's going to happen tomorrow. No one. It's not market timing. It's an active asset class allocator. What's working well? Let's position ourselves there so that we can try to ride that momentum. It follows the market. We're not able to pick the tops and bottoms. No one can. So I can't tell you tomorrow is going to be a high point or a low point. It's just responding and following the momentum of the market. Therefore, it's not day trading, but it's also not buy and hold either. We will adjust. We will make adjustments when there's clear direction in the market. There certainly was in 2020. It can change every single day. It doesn't. It usually trades about 6 times a year. Last year, 2020, just because of all the craziness, it traded a few more times, but we actually look at and score the momentum across the entire market each and every day. So what happened in 2020? Both in dynamic, but also in core and strategic. Within dynamic, the big shifts, it got completely out of stocks at the end of February. And you heard me right. When all the craziness happened in March, dynamic was already completely out of stocks. As things started rebounding in April, we started shifting back in. Dynamic started shifting back into the markets, but growth and tech that was what's in favor, not small cap or international. So all of dynamic went into growth and tech areas. And then really since November, the election and vaccines starting to be distributed led to small caps, led to value stocks, led to emerging markets all doing well. And so we've seen that rotation within dynamic. We haven't abandoned growth in tech, but we've sold off some of those winners, and we're riding some of the momentum in small cap and value and in emerging markets. So how's that play out? Our core and our strategic models, they're buy and hold. So you're going to expect that those are going to move really well and closely to the S&P 500. Now, we're holding more than just the S&P 500. I mean, our core models, it's holding the S&P 500, and that did exactly what the S&P did. But it's also holding international, it's holding real estate, it's holding small caps. And so it just so happened that last year, the returns of that were very close, moved in lockstep, finished just a hair under the S&P 500. That's appropriate for a diversified portfolio. But now let's compare that to dynamic. Outperformed to start the year, went into cash, got completely out of the markets during all the craziness. As things started rebounding, that momentum was confirmed. We started getting back in the market, and you can see, but back into the areas that had momentum. So we're taking more risk, growth and tech, and they outperformed significantly. The other kind of buy and hold, or even the S&P, significantly. It was a banner year for dynamic, a banner year really for the KFG models, which is a blend of buy and hold and a momentum approach. You really almost couldn't have picked a better philosophy or a better approach for what 2020 was going to bring. It was the ideal blend of being able to ride through the ups and downs. I mean, guys, I thought it looked depressionary. In March, it looked depressionary. If something didn't happen, you could quickly see that we could turn into a depression very quickly. And the buy and hold, I just got to be honest, I'm assuming you felt this way too. I mean, your emotions wanted you to abandon it. And yet we rode through it with the buy and hold, and we're rewarded for it. And so we didn't overreact to extremes in the markets. We stayed disciplined with small caps and emerging markets. That paid off. And guys, I can't tell you, almost couldn't pick it better. Rebalancing for strategic and core. We rebalanced at the end of January, so captured a lot of gains from January and the gains from 2019, because 2019 was an amazing year. We rode through the downs and things started coming back. We rebalanced again midway part of the year to trim off some of those gains and buy some of the areas that were underperforming that would eventually do better later in the year. So it was really unbelievable timing. And then again, in 2020, this ideal blend of riding through but capturing the momentum was clear. When everything dropped, we went to cash. And then we exploited the growth and tech momentum and trend that started in April, and then captured the rotational shift. The great rotation has happened. Did you know that of the big tech stocks, they call them the FANG stocks, Facebook, Apple, Amazon, Google, and so of those, right, those were the big winners last year. Only one has outperformed the market in the past 6 months. What a great, and that's a huge rotation. So therefore, we've trimmed some of our growth holdings and gotten into some of the areas that have outperformed. And I would also tell you, our income model, say your financial plan said, you know what, I need to have some dynamic for diversification reasons, but I don't want any in stocks. We used our dynamic income model. There's nothing in stocks that's designed to get high income, but using a dynamic and momentum overlay with it did unbelievable. That income model significantly outperformed the stock market as well. So how do we expect these KFG models, this blend of buy and hold and momentum, how do we expect that to perform and, well, respond to what's ahead in 2021? Well, number one, if I'm looking at record high valuations, lots of speculation, I would want to be able to capture opportunities as they're presented to us, but I'd want to have an escape hatch as well, just in case all of a sudden risk is very real and people start flooding towards the exits. I mean, speaking of that, you want to stand as close to the exit as you're standing to the entrance. Again, like all this money printing, it's either going to create a boom in the economy or things could absolutely fall quickly and very, very, very fast. So again, seems like 2021 it could be an ideal time to ensure that you've got a buy and hold strategy and a momentum strategy, dynamic strategy working for you. We expect volatility. There's a lot of speculation out there. There's a lot of big risks out there. We expect volatility. If the economy stays open, if the economy stays healthy or gets even healthier, I'd expect the rotation to continue. I don't think it'll be just growth in tech stocks that do well. I think other areas could do well also. But speaking to bonds, just with interest rates being so low and the money printing, potential inflation happening, there is just an imbalance between the risk and reward with bonds. In the area of bonds specifically, could be a great time to look at something fixed or look at some way of getting some dynamic bond or dynamic income exposure. If you're a fan of the Wise Money Show, you know that we're not going to leave any discussion without some action items for you. And so how can you apply what we've just spent the last half hour kind of talking through? Number one, make sure your investment strategies are diversified, that you're using two different strategies, not, day trading or owning Bitcoin and something else, right? If you've got some play money in that stuff, okay, fine, but make sure you got a diversified strategy so that you ensure that you don't have all your eggs in one basket, that all your eggs won't break at the same time. Make sure that you're taking the right level of risk in your investments for your overall financial plan. They've just got to be in sync. If you're taking an unbelievable high level of risk in your investments, but your financial plan dictates you really don't need that, you could be risking way too much. But the opposite's true as well. If your financial plan shows, hey, you've got a long time, you're not going to need these dollars for a long time, but you're taking no risk at all, that also isn't in parity. So make sure that you're taking the right level of risk for your overall financial plan. And then lastly, it's tax season. I'm starting to get tax documents in the mail. I'm assuming you are too. We're gearing up for it here. We always look forward to tax season, helping you with your taxes. But make sure from this discussion, make sure you've got the right investments inside the right tax shelters, using the right strategies inside your 401k. Some of these strategies make a lot of sense for your Roth IRA, don't make any sense for your 401k, don't make any sense for that trust account, right? So make sure you're sitting down with your CFP to see, well, am I holding the right investment mix inside my specific accounts, okay? How can we help? A lot of people have their investment review, the review of their strategies, their performance and all of that, coupled with a tax preparation meeting. And so we're going to see lots of you soon, right now, and coming up over the next couple of months. So I'd encourage you, that's a way we can serve you, sitting down, reviewing your entire financial plan, seeing if you're on track for your financial goals. That's another way our team could help if we're not serving you in that way. Home, auto insurance, reviewing that, health insurance, my goodness, tons of change there. And of course, we do all sorts of, accounting work and retirement plans and all that sort of stuff. So if there's any way that KFG, that our team of professionals can be of service to you, we would love to help. Just reach out to us if you don't have your tax appointment scheduled, if you don't have your investment review appointment scheduled, or you know someone that isn't getting this level of investment expertise, this buy and hold approach and momentum approach. You know someone that could use that help. We'd love to help them. So you can just give us a call, reach out to us at info@korhorn.com, or if you need an appointment or someone that you know. If you have any questions for me as well, hey, I didn't understand this slide, or what'd you mean by this? Just send me an email, info@korhorn.com. Or you can also just catch me every day on the YouTube channel or on Saturdays on the radio at 8 a.m., 9 a.m. On the radio right here on Saturdays, on YouTube, on podcasts. You can check everything Wise Money. You'll find me there as well. So thanks for your time. We look forward to seeing you soon and serving you for your upcoming tax appointment and your investment appointment. All right. Until then, take care.